Money functions as a sophisticated social technology, engineered to coordinate human behavior and reduce transaction costs. As this technology evolves, it is moving from tangible physical objects into a fluid stream of abstract digital signals. Without a monetary medium, economic activity is restricted to the barter system. This requires a double coincidence of wants. You must expend time and resources searching for a counterparty whose specific surplus perfectly matches your exact deficit. Money eliminates this frictional drag by acting as a universally accepted medium of exchange. It is a highly liquid intermediary, meaning it can be immediately converted into other assets or consumed. This universal acceptance allows individuals to specialize their labor. You can focus on producing a specific good, confident that you can trade your output for a medium that secures your diverse needs. Money also serves as a unit of account. This provides a standard measure for value, allowing for price comparison and the calculation of complex economic metrics. This mathematical standardization allows for the aggregation of disparate economic activities into a single metric, such as gross domestic product. Finally, money acts as a store of value. It allows economic agents to decouple the timing of their income from the timing of their expenditures, saving today to consume in the future. However, if an asset fails to maintain its purchasing power over time, the system suffers a failure cascade. Once it fails as a store of value, participants will refuse to hold it, and it inevitably fails as a medium of exchange. At its core, money is a structural mechanism of trust. Today, the architecture of that trust is shifting toward a programmable digital framework. Early societies often operated through gift economies based on social obligations. The transition to physical currency occurred only when trust needed to be extended beyond the immediate social circle, to strangers or distant trading partners. Early currencies utilized durable natural objects, such as these cowrie shells. They solved the immediate physical requirements of a medium of exchange. They were portable, easily counted, and difficult to counterfeit. Around the 7th century BCE, the use of metal coins introduced a major leap in standardization. By stamping precious metals with royal emblems, the state guaranteed the weight and value of the coin, eliminating the need for individual verification during trade. During the Song dynasty, China introduced representative money. These were paper certificates backed by iron or copper coins kept in government vaults, separating the medium of exchange from the intrinsic value of the asset. European banking systems expanded this model into the international gold standard. As seen at the Bretton Woods Conference, this provided a stable framework for global trade by linking currency values to a fixed quantity of gold. This system ended in 1971 when the United States suspended the dollar's convertibility into gold, marking the final departure from commodity-backed money. Since then, we have lived in the era of fiat money. These currencies have no intrinsic value. They are backed entirely by government decree and the collective trust in the issuing authority. Because fiat value is managed through institutional records, the stability of the global economy is now entirely dependent on the architecture of central and commercial bank ledgers. A foundational principle of modern banking is the singleness of money. This ensures that $1 in a commercial bank account is always interchangeable at par with $1 of central bank cash. Maintaining this parity is difficult because the global financial system is fragmented. It is a collection of proprietary databases held by thousands of individual banks. In this architecture, money doesn't actually move. Banks must send complex messaging instructions to update these separate ledgers. This creates friction through asynchronous clearing. Instructions wait in a queue for verification, necessitating constant third-party reconciliation to ensure every transaction is correctly recorded. This architecture leads to delayed settlement speeds, unaligned incentives between institutions, and elevated counterparty risk during the clearing process. The central drag on the global economy is not the currency itself, but the fragmented database silos required to track it. To resolve these major bottlenecks, the Bank for International Settlements has proposed a completely new structural framework, the Unified Ledger.
This new system relies entirely on tokenization, the process of representing claims on an asset digitally on a programmable platform. A unified ledger hosts central bank money, commercial deposits, and tokenized assets in a single programmable environment. Here, the transfer of an asset and its payment happen simultaneously. Messaging and settlement are no longer sequential. This delivery versus payment executes an instantaneous atomic swap. Executing on a shared platform guarantees finality and eliminates the need for post-transaction reconciliation. By adopting a unified ledger, the global financial system can transform settlement from a multi-day administrative process into an instantaneous digital event. Beyond speed, a unified ledger offers composability. This is the ability to bundle multiple financial operations and smart contracts into one transaction sequence. This could automate complex supply chain finance. For example, a company shipping goods could pay varying interest rates based entirely on the real-time location of its cargo. Using a unified ledger, a smart contract can integrate Internet of Things data, such as the GPS coordinates of a ship. When the ship crosses a specific geographic boundary, the ledger automatically triggers a lower interest rate, as the risk to the lender has decreased. This automatic execution reduces lender risk and supplier costs without needing human verification or discretionary monitoring. Composability changes the nature of money. It is no longer a passive record of value, but an active, programmable agent. While central banks explore ledgers, decentralized finance, or DeFi, is already operating through peer-to-peer protocols. DeFi lending protocols like Aave displace traditional bank functions. They use algorithmic over-collateralization and automated liquidation to manage risk, entirely removing the human loan officer. Managing the immense transaction volumes in these automated environments requires the use of artificial intelligence to make decisions in real time. However, as AI optimizes fraud detection, fraudsters are using generative AI to create more sophisticated threats. These threats include synthetic identities and highly convincing deepfakes designed to bypass digital authentication mechanisms. The primary danger is no longer just network penetration. It is the manipulation of customers who appear all green in security systems while being coerced into moving their own money. As financial architecture becomes increasingly automated, the human user becomes the ultimate systemic vulnerability. Driven by digital infrastructures and changing consumer behavior, the global economy is moving toward a cashless society. In Asia, platforms like Alipay have allowed millions to leapfrog traditional credit cards, using QR codes for transactions in both urban and rural areas. India's Unified Payments Interface has revolutionized its domestic economy, processing billions of transactions monthly and providing a global model for financial inclusion. However, sovereign digital currencies provide the issuing government with a centralized view of every citizen's transactions. This centralization introduces the risk of weaponized financial access. Governments could potentially use programmable spending to restrict the purchase of specific products like fossil fuels. We have already seen centralized ledgers used to instantly freeze the bank accounts of political protesters, as occurred during the 2022 Canadian Freedom Convoy. The shift toward digital money creates a direct trade-off: extreme programmable efficiency in exchange for unprecedented government surveillance and control. Centralizing national wealth onto a unified digital ledger also creates a high-value target for state actors. A single cybersecurity breach could disrupt an entire national economy. Furthermore, a fully cashless society risks marginalizing the elderly and those without stable internet access. Physical cash remains an unmatched, power-independent technology for disaster resilience. While digital systems provide efficiency, offline transactions provide uncensorable stability during power outages or systemic failures. A resilient monetary system must be multimodal, balancing digital composability with the inclusive offline nature of physical media. From cowrie shells to the unified ledger, money's evolution has been about the engineering of trust. The challenge of the digital era is achieving frictionless efficiency without sacrificing the privacy and autonomy of the public.